Geoff, good morning. Let me come to you first. What are you making of the vote? Increasingly, that gap currently, and we still got about half of the other voting outlets to really get through. But of the 175 that have been already counted, increasingly the gap is widening, and it's looking more like it's headed towards the leave vote. Does that surprise you, given that consensus seemed to expect pretty much a non-event today?
Yes, I think it is a bit surprising, but there is a caveat. Most of those areas are lower population. They're in the remoter regions. They're more easily counted. Those votes come in quite quickly. And the net leave vote was about plus 4% in favour of exit. But then once a couple of the big London constituencies came in, it swung around to a net balance in favour of Remain of plus 4%. And it's interesting that Nigel Farage of the UKIP party, one of the leaders for Brexit, has actually conceded that the Remain camp may win the day. So I think it's still a very close run thing, like the Battle of Waterloo. And we cannot at this stage say with any certainty which camp is going to win the day.
Fair enough. Peter, what are your thoughts this morning?
Well, good morning. Thanks for inviting me on the show. I'm going the opposing view, and I think that the votes will remain, and you will see Brexit. They will vote for not to stay in the EU, and the volatility that we've seen over the last matter of 5 or 6 hours has been monstrous. British pound, of course, where the yen is, and where the FTSE, just, you know, and of course pound as far as gold's concerned. So I think that volatility will remain over the next few hours. You don't see trading ranges like this very often, and it's not a bad time to be able to trade because there's plenty of movement out there.
Well, you know, Peter, I want to understand that if we do see that vote to exit, how much of it do you really feel is more led by kind of sentiment as opposed to pure economic sense?
Well, there's some sentiment too, and there's also speculation as far as markets. People take opportunities when you see volatility. What happens as far as the exit game and what the true mechanics moving forward, it's going to take years to dismantle, but it just gives, I think, a summary. There will be enough momentum there to, I think, greatly affect markets over the short term. I think it'll probably settle itself down within a couple of, maybe a week or so. But I think over the next, say, 3 to 4 trading sessions, it could be very, very large swings and cross when the US opens. So it's too early to call, but you don't see this very many times in your trading life. You know, we put our minds back to what Soros achieved as far as the UK, the pound in the 90s. These sort of situations happen few and far between. You're lucky to get them once a decade, and I think we're living through the decade one now.
Okay, I'm going to come back to you on some of those trading opportunities then, Peter, in just a moment. Geoff, let me come back to you. And I know you said that you still expect them to remain at the end of the day. But if we do see that leave vote come in, and given that markets were not expecting it, that would be a bit of a surprise. What's the worst that could happen?
Well, the worst is that we've seen that the general rise in uncertainty in the months running up to the votes yesterday coincided with a weakening in PMIs, a weakening in the leading economic indicators. And this is consistent with what sheer uncertainty, Knightian uncertainty, economists call it, tends to have. Businesses don't know what to do. They postpone those investments. They postpone taking on extra people. And so one would expect, at the very best case, would be a mild recession in the UK. And forecasters at the Treasury and the OECD have been saying, well, the UK will experience quite a large recession. That's not a systemic event for the global economy because the UK is only about 3% of world GDP, but there could be important negative spillover effects through financial contagion, and that is the big worry, of course.
Absolutely, and a lot of interesting points there to talk about as well. Peter, in the immediate term, you know, given the kind of volatility or the swings that we are seeing, what are the kind of trading opportunities you see? What are you looking at? What are the kind of moves that you're possibly advising or looking at closely?
Well, when you're looking at currencies and just the sheer volume of the market itself, those opportunities allow retail investors to enter and exit a market very, very quickly. Depends on their risk thresholds, and it of course depends on what style of market they trade in the sense of a derivative. Are they trading options, futures, or are they trading just straight out on a platform forex? So that allows that enter and exit of a market very highly liquid, but very, very quickly. And many traders are seeing little opportunities, and they may be in a market for 30 seconds or a minute, or they may only be there for a matter of seconds or take a longer view. So many have different strategies, and those strategies are fluid. And people are watching numerous markets, and they spread their risk, or they look at numerous markets in any particular opportunity or session. So, the sheer volume, I think, and the retail sector would be very much engaged in this right across the globe as we speak.
Absolutely. Geoff, I want to come to you as well. There have been, several pockets of industry that have been very closely watching this to see how it would impact them, taking from where Peter left off. The impact on share, for instance, on the MNCs, on the sort of corporates that are based there, on trade. Like, what is the extent of the impact that you foresee? I know you said it might take a few years to unravel, but what could we see there?
Well, I think there are so many potential scenarios, political and economic, after Brexit. There will be a lot of uncertainty that we just cannot say what the effects will be. We won't really know for quite some time. It's quite possible, of course, that we could have a Brexit vote. The government could fall. There would be a general election in 6 months' time, and maybe a Labour Party coming back that was committed to staying within the EU. There are so many potential options that we really won't know in the short term. So I personally think that the economic effects will be quite a lot less than the more dire predictions that we've seen from the Treasury model. Those macro models are not well suited to estimating the impact of an event like Brexit. It's the answers are fed in and then they come out of the computer. So I don't attach much credibility to that. At the end of the day, the worst case, economic case facing the UK is that it gets WTO treatment. The average tariff in the EC is only about 3%. So per se, I think the impact on the UK economy will not be as bad as the worst case scenarios that we've seen from the brokers and the forecasting institutions.
All right, fair enough. The situation you described, Geoff, and I put a disclaimer there. Like you said, we could actually see, see that swing once again in the next couple of hours. But the situation you described sounds really dire. I mean, if we're looking at the EU, and if we do see Britain vote to exit, whether the government falls down, whether there is a bit of uncertainty over the next 6 months, markets just don't like uncertainty. And given that we're already seeing the Eurozone as one where we've seen a lot of instability politically, that can't mean well for market sentiment worldwide.
No, it will be a risk-off event, and markets could fall quite sharply in the short term. But I think they can recover. The degree of reflexivity between financial markets and the global economy is often exaggerated. Looking at the underlying economic trends within the European Union, despite all the political problems over refugees and so on, the economic trends seem to be improving. The European economy is in relatively robust state at the moment, and some policymakers at the ECB have come out and said that no further monetary easing is necessary or being contemplated. So I think that whilst in the short term financial markets will riot, investors don't like uncertainty, as you say, the statistical evidence is that uncertainty is a negative for economies, but the effects tend to be shorter and shallower than, say, from a real major shock like a doubling of the oil price.
Okay, let's pull up the pound again and just take a look at where it is. I think we've seen another sort of swing in it. It's okay, 7.3% lower. Piyush pointing that out to me as well this morning. It's trading the dollar versus the pound is now at 1.3. That's a 7% shift that we're seeing on that currency. Peter, coming back to you, I mean, you know, we've been looking at these currencies in a lot of detail. In fact, I think Soros was predicting that he saw a 20% drop on the pound, you know, if the Brexit vote were to come through. The vote's now 51.6% voting to Brexit. You know, how much more pressure do you feel even we could see on the currency, even in a completely immediate term horizon while we're voting?
Okay, well, we're still quite a few hours out from the final count, and you're down 7.6%. Maybe Soros's view of 20% is bullish, but you know, I think you'll hit double numbers. You'll hit probably 10 plus. I wouldn't be surprised that to happen within the next few hours. So it's going to be a very, very interesting ride for the rest of the day. You've got Asia really coming online. You've got HSBC. I saw some numbers just then out of Hong Kong. They're down around about 6%. So financials are going to be hit hard, dependent upon where they draw most of their revenue numbers. A lot of these big institutions naturally from Europe. So all of that starts to unravel. Then you'll see what happens in Tokyo, rolling across to India, and of course then the Middle East and leading into Europe. We've got a long way to go until New York shuts tomorrow morning. So there's plenty of action ahead of us, and I think it's going to be, you know, a very, very wild ride. Where do you hit that? What's the final number? If you're a trader, you've got to be very conscious of your stops, and you know, it's not for the faint-hearted, this sort of trading.
Absolutely not. And Peter, what's the kind of implication that you see on fund flows? It may be too soon to kind of take that call, but nonetheless, in terms of, you know, do you see a freeze? Do you see, you know, a completely risk-off sort of mood is coming in, you know, until some of this settles down? What's your take on that?
Well, first off, I just want to say gold's just now through 1,300 US. Now, that's the big push. It's going to be interesting to see what it is as far as UK pound. I just saw that number come up on the screen. So that gives us some sort of an idea. It's very, very much from the risk side. We're going to see, I think, a lot of freezing of employment of capital. It'll be very much a wait-and-see approach, and where it runs, it's too early to call, but I just think naturally what it does create is a lot of confusion to a market, and that creates the volatility. And at the present time, I think we're going to just sit on our hands. A lot of these, you know, as far as fund inflows and you know, economies are going to just have a close look at this over the next matter of days, because this is groundbreaking. And if it does go down that pathway that you do see a Brexit, then I think that the book's never been written, and we're going through uncharted waters. So it's going to be a very interesting look back in a week's time and see, you know, the vol swings and what happened.
Right. Geoff, let me get your take on what's happening on the currency front and on some of these commodities. I mean, we're seeing a clear reaction to the entire vote and to the event. What's your take there?
Well, yes, this is going to be a classic risk-off episode in the short term if there's a narrow vote in favour of Brexit, and that's going to affect all risk assets, and correlations will rise, and a lot of people will be very confused by the uncertainty, not sure what to do. If there is a vote to Brexit, then there's actually a very long path ahead. Article 50 will be triggered at Cameron's own time and choosing. The EU cannot throw us out ahead of that. And I think the negotiations that will take place, there'll be an attempt by the UK to get a memorandum of understanding to get some key agreements before Article 50 is triggered, and then there'll be a 2-year window to actually close on the deal. And I don't think the EU are going to want to punish the UK. It's not in their interest. It's in their interest to maintain a deep and close relationship between the UK economy and the European Union, just as there is between Norway and the EU. So I think whatever the collapse in stock prices and currencies that we see in the short term, in the medium term, they'll tend to come back because people will realize that it's not really a Lehman event in terms of triggering a 2008 global recession. Far from it.
That's a really good point, Geoff. I also want to get your view on this from an emerging market standpoint because, of course, a lot of trading calls being made here, but closely also watching it just in terms of volatility and fund flows, and as you mentioned earlier, any possible contagion effect. Do you think we need to be worried when you're sitting here in India, apart from a general, so perhaps a risk-off reaction in the immediate term? Is there much more to be worried about on a broader scale?
Well, I think if we looked at the market action in the last week or so, when the Brexit just swung ahead, and then after that, when it began to swing back in favour of Remain, you saw the markets that have been hurt the most, obviously the UK and Europe, up 8%, up 5%, Asia up 3%, but India rather flat. So and the markets would tell you that India is perhaps less vulnerable either way. My view would be that all these studies which tell us that Asian economies only export less than 1% of their GDP to the UK, so therefore it doesn't matter so much. It's not that trade link, it is the financial link, it's the contagion, it is whether there'll be a big withdrawal of money from the emerging markets in a risk-off episode. I think one of the things which leads me to think there won't be, or that it won't be as bad as these worst-case scenarios, is that everybody was pretty much underweight the emerging markets in the first place. There's not been a lot of enthusiasm, so a lot of money hadn't come into the emerging markets. There's less money to come out on irrational Brexit fears. If money does flood out, in my view, it will be, again, an irrational response by investors because the best growth prospects remain in the emerging markets. The economies which are standing up and still have positive growth, positive interest rates are in Asia. So it will be an irrational response by investors based in the US and Europe, but that's what we have to live with, I suppose.
Absolutely. I just want to also just mention that it's pouring in London, and it has been, in fact, since yesterday. So a lot of those voters maybe also choosing to stay indoors. It's been quite a downpour that we've seen there. All right. Peter, let me come to you on more of really the impact that you also see on the bond markets. I mean, we were just looking at those gold prices. We're also looking at the currency. What's the impact you see when it comes to the Treasury bond markets on that front as well?
Well, I mean, that's another market altogether.
Yeah.
And, I'm just seeing the pound here now nearly at 7.9% down. That's very, very difficult to contemplate. You see the situation as far as Switzerland. Have a look at the numbers that come out as far as Germany, negative yields, all of that. I mean, where does the States go? What do they do as far as Treasury? I think that Yellen won't see lift off in this year. I think, and that is nearly confirmed. So again, it creates more confusion to a market. And this is only the first start of it. I think we're going to the next part, which will impact the market as well later in the year as far as the Hillary Clinton and Trump situation, who gets elected. So all of that again, and we've been saying this for the last couple of months, it's going to be a very, very volatile trading year. And I think as the year rolls on, you take on board those bond prices, take on board the currency swings, emerging markets, look at fund inflows, equity markets. It's just a melting pot at the moment, and this creates, those very, very large swings. And it's very, as I said, it's hard to contemplate what happens to bond prices.
Absolutely. All right. We had the Bank of England also saying earlier today, I think, to the press that they're ready to intervene should they need to. And they're standing by, absolutely, and there's actually talking about the votes and saying just the kind of shock we were expecting. So financial markets are all geared up. That vote now, it's 51.2% to leave and 48.6% 7-8% to remain. So it's still holding steady with that gap. On a completely different note, Geoff, Peter just brought up the Trump election, the Brexit vote right now, a lot of it being attributed to xenophobia. I want to understand from you, I mean, as you said, financial markets will get through these events and move forward, or will they? Because a lot of these events have a lot more to do with sound and economics as well. There's a lot more going on here.
That's right. I think what you're referring to is this general disillusion that we seem to have in a number of countries with their political elites, with their governments. And we're seeing that in the Trump phenomena. We saw it in the Philippines, in the Duterte phenomena. We're now seeing it in a vote in Britain, perhaps in favor of Brexit. So there's a lot of dissatisfaction. A lot of this is driven by very fundamental trends that have meant a downward pressure on real wages and living standards, particularly of the working classes and the lower middle classes. It's only the 1%, if you like, of the income distribution, plus the upper middle classes, as Brookings reminded us a couple of days ago, that have really seen benefits from the reflationary stimulus that we've had from central banks post-Lehman. And this is leading to a lot of worries, a lot of underachievement. People are no longer so confident about their economic futures, and this is leading them to question the political leadership, policies and governance that they've had. So there are some very deep economic trends that are behind things like the possible Brexit vote.
Absolutely. Peter, a lot of the central bankers, and that too around the world, have talked about stepping in when required. We've also been waiting for this event to get out of the way so that we can see some of the central bankers act on things that they've been meaning to. They've all been waiting for the Brexit to first pass. So whether it be QE, whether it be the Fed and it deciding on its rate hike stance, whether it be further QE in Europe or Japan. I mean, we've been watching out for some of these key events. How do you, what according to you is going to be a priority for some of these central bankers going forward?
First off, I think they've got to look at the results of today. Then naturally they're looking at bond yields and they're looking at where the currency situated. The second part is how do they stimulate? Your other guest hit it on the head. Absolutely right. And that's going to be one of the key drivers why I think you're going to see a Brexit, because the greater majority have seen zero wage growth, really, and their living conditions and standards have been subpar compared to what they were 15 to 20 years ago. People are all working harder now and for less return. So that's one of the reasons. So there's a dissatisfaction, and that's coming across every vein of politics, from the Philippines, yes, all the way across Europe. What's happening, we've got an election here very shortly in Australia, or about 2 weeks out, and all of these factors are coming to play. So governments have only got so many levers to work with, and you're getting to a point, negative QE, negative rates across the Eurozone, what's happening with Japan. It's nearly to the point of a race to the bottom. And if we hadn't seen energy prices trying to get that inflationary number, and they're starting to see, back at $45 to $50, I would have thought that, maybe crude is probably maybe the jump, the kickstarter to get the global economy going again. But I look at it and I say it's fairly fractured. And I'm not sure whether you're going to see actual growth there in those sort of numbers. I think that the crude market's pretty well grown. So if you roll it all across, the governments are fairly tight. They want to see more spending and more entrepreneurial spirit and more people taking risk. But at the present time, I don't think people are prepared to take risk. And that's been very evident by the banks and what they're showing as far as negative rates.
Absolutely. Geoff, I want to get some closing comments from you as well before we wind up this length of the discussion.
Well, I think those are great comments from Peter. I agree entirely with what he's just said and his analysis. And I think the people who have been unwilling to take risks in the last few years are not the central bankers. Obviously, they've done everything they can, but governments that have pursued austerity in a time of depression or recession risk, they've failed to measure up to expectations. All this talk about helicopter money, it's simply monetary and fiscal policy working in the same direction. And I think if I'm wrong and Brexit is a sufficiently negative risk that via financial contagion we see the global economy weakening, then I think we'll probably see helicopter money coming in as a last-ditch attempt to save the day.